Session-7, Precious Metals Outlook Roundtable. We have three excellent speakers plus Nikos to moderate the session, starting with Mr. Bart Melek, who is the Managing Director, Global Head of Commodity Strategy, TD Securities. A round of applause for Mr. Bart. Following him is Mr. Bruce Ikemizu, Founder and Chief Director, JBMA, and Mr. Jordan Eliseo, General Manager, ABC Bullion. A brief introduction about each one of them, but as I play that, a little bit of work to each one of you. With the permission of Nikos, I will request our people on this thing. Can you put the first poll? We would like to take your views on the price, as I request all of you to use the mobile, scan and put your views as I read the bios of the speakers. Bart Melek heads the commodity strategy at TD Securities, providing macro and market views across precious metals, base metals to institutional and corporate clients. He is widely followed for his analysis of interest rates, currencies, and macro trends and how that shapes the precious metals and investors' positioning. Mr. Bruce is a founder and chief director of Japan Bullion Market Association. With decades of experience in Japanese and regional bullion markets, he offers unique insights into physical demand, investor behavior, and role of Japan within the broader Asia-Pacific precious metals context. Mr. Jordan Eliseo is a respected financial markets commentator and precious metals expert with more than 25 years industry experience. Mr. Jordan is a general manager of ABC Bullion, Australia's largest independent bullion dealer and part of Bullion Group, the largest precious metals services group in Australia. Before joining the bullion industry, Mr. Jordan worked at companies including JP Morgan, Deutsche Bank, AMP Capital. He later became the head of investment analytics at Casinova Capital in London, where he specialized in building risk and attribution models across hedge funds, equities, fixed income, and multi-asset portfolios. Jordan is also the author of two books, Dire Straits, Money for Nothing, Debt for Free in 2015, and Gold for Australian Investors. Right, that's good enough 5 minutes for people to give their views as well. Over to you, Mr. Nikos.
Thank you very much, Vatsa. First of all, thank all of you for accepting the invitation, for being with us. I want to start with the most pressing, timely topic. We've had these announcements for that the war is probably going to be over very soon. What do you think this means for gold prices, and if you want to stretch to gold investment in the short, let's call it 1 to 3 months, and the medium term, let's call it the next 12 months. Start with Bart.
Okay, well, we're certainly hoping the war is over. There's every indication that oil is going to start flowing through the Straits of Hormuz again. But the fact of the matter is the global oil sector has been damaged quite a lot, and we don't think there will be a normalization for another 6 months or so. We're still expecting to lose 800 million barrels or so of inventory into October and November. You might ask, what does that have to do with gold? Well, we could still have elevated oil prices for the next year and a half, even 2 years, as not only do we have to satisfy current demand, but probably start refilling inventory. And that means inflation risks will be with us for quite some time. The corollary to this is that interest rate projections will continue to be quite elevated, not necessarily sloping upwards from here on, but we're going to have concerns that inflation will be here for longer, and that means higher interest rates for longer, and Fed very unlikely to tilt towards easing anytime soon. In fact, I think we're going to continue to worry about tighter monetary policy, which will have an impact on carry, which will have an impact on opportunity cost, and certainly the US dollar. So we don't really see markets moving too high. Will be range bound around 4,000 to maybe 4,300, but no takeoff to the upside quite yet. Eventually we think yes, but not quite yet.
Thank you.
I think, we I mean, at this moment, we're not quite sure if this agreement, I mean, we don't know the context of agreement, and it is, you know, it's always Trump's case that he says he had a wonderful agreement, but we don't know the context, and Iran also doesn't show the context yet. So in very short time period, I don't still we may have the risk to go down to 4,000 probably, but I kind of hope and feel that the 4,000 big figure is the bottom of the market, and we have already seen, I mean, enough selling for short-term investors. So in short term, we may have some more turbulence, but again, for a longer term, a little bit longer term, I'm forever bullish on gold, and as the metals focus, the forecast for the a little longer term, I would expect gold go back to 5,000 to the year end if this Iran-US conflict in somehow solved. Sorry.
I think it's analysing the impact of the Iran war as it relates to gold specifically is quite difficult because there's not that many cases where conflict has broken out in the Middle East in the past where gold had rallied 50-60% in the 12 months leading into the breakout of the conflict. So if you look at what had happened in the gold market, and let's say precious metals more broadly, will include silver in this, the sort of super surge that we saw definitively ended at the end of January. It was January 31 when silver dropped about 30%, gold dropped several percent that day as well. The breakout in conflict didn't start for another month later. So we were sort of already at the end of this euphoric rise in precious metals, and that consolidation period was overdue, very healthy. I think many market participants who are long-term bullish, and I think we're probably all in that camp, we're all thinking, look, this needs to cool down. It can't sustain this pace. I also think that if you look at gold's performance through this period of conflict, yes, it's been a little bit confusing for some, given they would expect safe haven demand might go up when there's a war going on. But there are also other assets that have performed, you might think, abnormally. So if you look at the S&P 500, it went up 20% from mid-March to end May. That's confusing that occurred in a period where a war's happening as well. So I think if you look at all of these factors, dollar rose, yields rose, equities were unbelievably strong. Plus you had this, you had a super surge that had to unwind. All of the moves we've seen in gold in the last couple of months actually really do make sense. Moving forward, I think, it almost helps to ask the question, well, what if the Iran conflict hadn't happened and we were just looking at the outlook for gold? A lot of us would have expected a pullback, which we've seen, and then all of the long-term macro and market factors that we expect to take over, well, they're still there too. So I think this is a fairly, this period we've seen is a fairly healthy and very normal correction, and the bull market in precious metals will continue.
Interesting. Well, since you talked about the long-term bull market, that's actually the next topic I wanted to cover. What are we thinking about the long-term bull market? Are we still happy? Do we still think it's intact? And why, obviously?
I'm happy to start on that one. The short answer is yes, because the dollar value of the moves that we see now is obviously magnified, but that's just because we've got a much higher price point. If you look at the correction we've seen in precious metals in the last, let's call it 4 months now, it is extremely, it's like a rinse and repeat. We've seen it happen 5 or 6 times over the last 25 years. And we actually recently published an article on this where we looked at the average time that it took gold to essentially complete these pullbacks, how far it would typically end, say, below the 200-day moving average, and how often it would then take to recover to the prior peak. And as I say, there's been 6 or 7 times in the last 25 years where after gold had run, say, 15% above the 200-day, it always ended up correcting below it. It typically ended up about 10% below it, and it took roughly 200 days. So if history repeats, we're going to see gold bottom out around $4,000 somewhere around August. And if that happens, it's just going to be, well, that's just another tick in the box. It literally is a rinse and repeat of what we've seen.
Well, I think in past, like last 20 years, we had seen this kind of move 3 times, including this time. Like 2008, we had like 29% dip, and 2020 with the COVID shock, we had 27% down. And then look at price right now, it's much higher than the price, in 2008 or 2020. And so we had this 27% down from the January 31st till now. I think this is, the same kind of, because the absolute price is much higher, so you will see like $1,500 move is huge. But if you see it as a percentage-wise, it's the same kind of correction. So I think this is quite healthy move, and for a very long time, I'm super bullish on gold with this global debt situation and also devaluation of the fiat money. I see no reason that gold go down from here to like, 2,000, 1,000, like 20, 30 years ago price. So I'm quite happy to buy the dip, and I'm really doing it. And so I don't care about short time, but I'm looking at like 10, 20, 30 years market.
I certainly think gold has significant upside. In fact, I'm very positively surprised that we didn't breach the long-term support, which, in our opinion, was between 3,900 and 42. Today, I think we're at 4,300. So the market is still fairly firm, and as far as the longer term, 12 months out, we're looking at a quarterly average in the second quarter of next year at 53.50. Given normal volatility, I think we're not going to be far off the $6,000 mark. And why? At some point, we are going to have inflation stabilize. We're going to be talking not inflation moving towards 4.5%, 5%, but trending down on the headlines at least to 3%, with core starting to drop significantly below, the 3% level. I suspect core inflation might stick around 3%, but once it tilts down, the Fed will have the freedom to once again, maybe tilt towards the maximum employment part of their mandate. And I think once that happens, carry starts getting easier for people. US dollar probably weakens somewhat across the board. And the same problems that we were talking about when gold surged past $5,000 in terms of financial repression, US dollar weakness, and the general way move from treasuries into other asset classes, I think is still on. And I think we're also going to be, again, revisiting the idea of using gold as a diversifier from away from a 60-40 portfolio to include commodities, which of course will have gold as a very important constituent. And that means, I think, everything from bullion bars to most likely prop funds getting in. They've missed a lot of it, several times, and we're certainly seeing on the ground, and this is from equity investors, where they are keen to look at gold. They look at it through a prism of what I was just saying, and they locate through ETF exposure, and I've not seen this type of interest from generalists in equity markets ever. So this is something new, and I don't see 6,000 as a problem longer term.
I'm going to move to having done the macro side, I'm going to move into some more micro market-specific areas. But before that, I just wanted to invite everyone from the floor. If you have any questions, please put them on Slido, or if you want to, if you want to actually take a microphone and ask us questions, that is also very welcome in a moment. But let me start with Bruce. Can you touch a bit on physical flows into and out of Japan? There's all this news that it's becoming more and more difficult to get secondary material out of the country. Can you tell us a bit more about it? Because that's quite a hot topic.
Right. Just before that, I would say that last year was a fundamental, very huge investment interest in Japan, gold, I mean platinum, also silver, and it was, gold ETF went like 20% premium, and gold futures, OSC futures commanded like $100 premium over local London forward. So it was really, I've been in this market 40 years and I've never seen that kind of opportunity. And it was I really wanted to go back to as a trader, a bank traders, you know. But anyway, so that kind of fundamental investment interest is on one side, and on the other side, probably not many people know that Japan is a very huge exporting country. Last year, Japan exported 228 tons, and while our import is only 10 tons. And we have only one gold mine in Japan, which produces 4 tons a year. So it doesn't really, adds up, and which because of this is because of the smuggling of gold. As you know, probably that we have to pay consumption tax when we buy gold in Japan. But when we sell, we get the consumption tax back, 10%. So if you buy gold from, I'm not recommending to do it, but if you buy gold in Hong Kong without tax, and then you just smuggle it in and sell it in Japan, you get 10% more than you paid. This is becoming a big problem. So like this 228 tons, out of this amount, I would say 90% is smuggled gold. So we are facing a huge problem here. Nikos pointed out, our secondary market, which is circulating gold market, is kind of dead. There's just 2 layers of the market, like smelters, trading houses, and big retail players. They only trade the virgin bars, and second-hand bars nobody wants to touch, except for some smaller shops and pawn shops. And those bars are exported out. So Japan is losing a lot of consumption tax money. And this is a serious problem, and the government is really trying to fight about it. And so I just want you to let know, because I had several meetings here this time, and people tend to think that Japan is very huge import country like China or India, but it's just the other way around. We are exporting the gold, especially to like Hong Kong or Southeast Asia. So this situation is actually continuing more than 10 years, and we are facing huge problem here. Thank you.
John, I want to get your thoughts on the small product market, small format market. You guys do a hell of a lot of business on that. So I just want to get your thoughts on this like dramatic sort of contrast between, December, January, where you just couldn't get enough product to deliver to customers. You had, famous pictures of queues outside your beautiful shop. And that, that was not just you. We saw that in many, and it was one of the very few times where in my career I've seen all geographies being extremely aggressive buyers. And then you contrast that with, March and April, where, you had buybacks, March, April, May, in fact, buybacks, demand very low, very little interest. Can you give us some perspectives on that, or what you guys saw and what the drivers of that shift was?
Yeah, I think 3 or 4 comments on that. Actually, the surge in demand, it wasn't just Jan and Feb. Really, I would say it was kind of more from mid-September through to mid-March, with a bit of a lull around late November, early December. But certainly the crowds that we were seeing out the front of our stores, not just in Sydney, which is the one that was on the news, but our other stores nationwide, that was a multi-month phenomena. Interestingly enough, though, it's the old saying, the tip of the iceberg. For every one person that was lining up in the physical queues, there were 10 people creating accounts online, trading online, over the phone, you name it. So the vast majority of our turnover and trade was not being serviced through the stores, as it were. Look, in terms of what was driving it, I mean, obviously the price was the main thing, and all of the catalysts for why gold and silver were doing well, and certainly by late January, it had definitely reached a sort of FOMO euphoria moment, and that was one of the reasons why the pullback that we saw really wasn't unexpected, because that sort of thing's not sustainable. Interestingly enough, though, when it comes to demand now, and I'm talking about retail demand, and maybe Australia is a bit of an outlier, but it's still very healthy. So it feels quiet, and it is definitely a step down from what we saw in that 4 or 5 month window. But if I sort of think of the gold market, and not everyone would look at it the same way, but I sort of see that 3 or 4 key periods of the last 20 years where the market changed. GFC was one, Trump and Brexit in 2016 was another, and then COVID, was the third one. If I look at retail demand now, it is, even though it's pulled back from the highs, it's basically at about the same level as the average of the post-COVID era. Now, the post-COVID era is much bigger than the pre-COVID era, so we're still seeing pretty healthy demand for bullion. It's just not at that sort of euphoric level that we were seeing, a few months ago. So I think the market's pretty healthy, and that's great to see.
Yeah, that's also the general view that we get from other markets, as Metals Focus does our research, that yes, volumes are definitely down in Q2 compared to Q1, but historically they're still pretty decent.
Correct.
People still love gold. Bart, I wanted to get your thoughts on the official sector, the central banking side. Look, we had 3 spectacular years. Everyone expected that there will be a slowdown at some point. We have seen a bit of a slowdown. We even have some, opportunistic, let's call it, selling having emerged. What are your thoughts? What do you see? I mean, I know you're very close to a lot of central banks. So where do you see the market?
I think central banks will continue to have a very keen interest in gold for the long term. When you look at various surveys, including the World Gold Council, there's a lot of evidence out there that they want to participate in this market. And I think, if anything, the proof is in the pudding here. 27% of reserves in aggregate are now gold. We calculate that to be closer to 30, but it's much, much higher. Of course, it's a combination of the price surge and more ounces. I think there's a bit of a lull now. Certainly conversations with central banks, and of course they never tell you what they're going to do, but you can infer, like any other investor, they were looking for better entry points. And I suspect that we've consolidated at these levels and moved up a little bit. You might start seeing a bit more appetite. And I think longer term, there's probably a lot of room, particularly for a central bank like the People's Bank, which still has, I think still with current data, under 10% of its $3.2 trillion asset base in gold. The general view out there is that there will be a slow-moving debasement of the U.S. dollar. That doesn't mean U.S. dollar collapses or anything like that, but the fiscal realities here are that U.S. is going to have to issue ever more treasuries to cover its fiscal requirements. We're at $39 trillion. And this, that's only the United States. Now we also have a situation where NATO members will be spending 5% of GDP on armaments. They don't have the money. They are going to have to probably go through the Eurobond market. That means probably a lot of pressure along the yield curve on yields. And that is inconsistent with strong nominal growth. And I suspect that, once this whole oil business is settled, these pressures will again emerge. We're going to be worried. And central banks, for one, they want to make sure that they preserve the purchasing power of their FX reserves. And second, I think there's a geopolitical component, certainly after the invasion of Russia on Ukraine, the sanctions that were levied on them. Gold proved to be a very good asset, which was, had its own intrinsic value, and you couldn't sanction it. I think there'll be more of that to prevent erosion of purchasing power and just broad diversification, and for geopolitical reasons as well. I see this program as going on for another decade, I think at least.
Thank you everyone for posting some questions. I'm going to pick up, there's a question that came in, thoughts on SpaceX's impact on gold, and I want to expand it a bit more because it's not just SpaceX. I think we can, and I want to ask Bruce your thoughts, because look, in addition to the very strong physical or gold accumulation plan demand that we have in Japan, we've also seen a lot of demand through all these securities companies that now have gold products or CFDs on their platforms. How do you see the interplay between the strength of tech equities and gold? Is it a threat because they divest? People don't pay attention on gold because they can get these extreme gains, or is it actually an opportunity because you see investors diversifying it or into gold in case the bubble eventually bursts?
Well, first of all, I got SpaceX three lots. So I got lucky.
Congratulations.
Above $200 now, but only three. But anyway, last year, I think last year is a major change in the Japanese investment world, because people are looking at gold as alternative to the equity market. People are feeling very nervous about weaker yen. It is going weaker and weaker. And today, just about 1 hour ago, BOJ raised the interest rate. But dollar yen is still 160.30 or something like that. So people are feeling that their asset is losing value. And I always say that to protect the asset from inflation and weaker yen, the best is to have gold in yen. And that is becoming very popular. So gold ETF, gold futures, of course, physicals, accumulation plans, and is, I think, getting more and more popular now. Let's say like 5 years ago, gold is looked at as kind of strange thing. But nowadays, gold is very popular and one clear alternative asset for Japanese investors.
I'd like to add to that. Before coming here, I was in Asia with our in Japan, Kuala Lumpur, with our equity and fixed income teams, talking to investors. And I'm increasingly seeing questions and a lot of appetite to have gold in their portfolios for the very reasons that Bruce was mentioning. Yes, equities are doing great, and I think, it's actually quite surprising to me how gold has been doing when you have risk appetite to that degree and such, impressive by historical standards equity valuation increases, and still there's interest in gold. Investors, I think, increasingly are thinking that it is appropriate to use something like gold as an alternate asset in their mix to make their portfolio sort of bulletproof. And we do know from historical data that gold tends to be counter-cyclical to equity performance, and does well when equities and risk appetite might drop. And look, over the long run, you will have a correction. It's seldom true, I think never true, that an asset class continues to go up continuously and forever. So I think gold will find a bigger and bigger role as time goes on, not only in Asia, but I'm seeing the same thing with equity investors in North America and Europe as well. I think this is the new reality, and we'd like to say that this is the future, but we're really going back to the past where gold and real physical assets are seen as something that is a stabilizing element in portfolios.
I think the first comment I'd make is I think Bruce took my 3 SpaceX shares because I didn't get any. I applied in Australia to get some, and all the brokers had to cut back their allocations to clients because it was obviously so heavily oversubscribed, and I suspect we'll see similar things with Anthropic and OpenAI in the coming weeks. It's unbelievably similar and a massive reminder of what happened 25 years ago when the NASDAQ had its first run up to 2000. I was actually working at a discount broker at the time, and the parallels are that there's so many, I suppose, red flags that have been ticked again this time. I think in the short term, the impact of SpaceX and the sort of broader US tech trade, let's not make it just about one company, it probably does have an impact on gold in the sense that any hot money that was happily chasing gold late 2025, early 2026, it's moved on. It just so happens to be tech right now, but it could be anything else. But that's really more about the euphoria in gold ending rather than SpaceX filling the void, if that makes sense. I actually think in the long term, though, and for more sophisticated investors, and this probably more reflects the points that my colleagues have made here, they see the benefit of combining the two, because when you hold an asset that's as liquid as gold is, that is as counter-cyclical as gold is, and that has the track record and the precedent that does of providing robustness to a portfolio, well, then you can be more confident going and allocating money to these higher risk parts of the equity market. So in the short term, yeah, the euphoria in tech is maybe one of the things holding some money back from gold, but in the long term, I actually think the ability now to easily combine gold and combine equities in a portfolio is only good for the bullion market.
There's another question that's good for all of us. Gold is viewed as a diversifier. I guess it's the question that we've been having recently. We've had 6 or more months of positive correlation between gold and equities. Does that mean gold is not a diversifier, not a good diversifier? I mean, if I may start with how I see things. An asset's diversification properties is really something that you look at over not periods of 6 months, but over periods of 20 years. And gold is actually not necessarily negatively correlated with equities, it's just that the correlation is typically statistically insignificant. So that, to me, that says it's a great diversifier. And personally, I think this positive correlation recently is testament to its perception as a diversifier, because investors have been looking at their equity holdings going up and diversifying into it. But what do you guys think about that? Do you agree, disagree? Have you lost faith in its ability to be a diversifier? Or have your clients lost faith in it? What do you think?
Well, look, I think in the short term, you sometimes, and quite often, in fact, get the decoupling, and not only from equities, but from interest rates as well. The most recent vivid example is when we had the Federal Reserve undertake the most aggressive tightening since in 40 years or so. Gold was hovering up around $2,000 and was moving higher. And I often had questions posed to me, has gold lost its link to interest rates? No, not at all. But gold might have been much higher if we had interest rates go the other way. We have to realize we live in a multivariable sort of environment where there are a lot of elements impacting the price of any asset, and gold is no different. And it has been, in my opinion, quite instructive that even in an environment where rates are quite high, it's been moving higher. That's testament to investors' commitment to using gold as an asset, something that is coming into its own. And I think, very important part is it's being fortified by the commitment of central banks, which is, we've seen the most gold holdings since the Bretton Woods system has collapsed. So I think it is a diversifier, and to your point, Nikos, it shouldn't be judged based on 6 months or even a year. We're talking about a decade or two. This is a long-term investment meant to preserve purchasing power over the very long term for large asset holders, such as central banks. They have very long timelines. Bruce?
Yeah, I totally agree with Bart. When the U.S. 10 years late hit 5%, last time was like gold was around 1,900. But before that time, I think it was 2007, the rate was 5%, and gold was $700 per ounce. So I think the interest rate and gold relationship is much weaker now. And one thing is that Chinese central bank is buying gold and selling U.S. long-term bond. Then the interest rate goes up and gold goes up. That kind of thing happened like this couple of years. And so I think I don't know, in the point of diversifier, maybe it's not diversifier or risks, but as a hard asset, I think the gold or other precious metals is instinctively different from stocks or currencies. So in that sense, I mean, I think your risk is diversified, and I think it's good for us not to worry about the interest rates for such sensitively. I think this is a situation at the moment.
Jordan, in addition to your own thoughts, even more interestingly, what do your customers, how do your customers respond to this situation?
Look, I think the vast majority of our customers are long-term precious metal holders, and particularly if you're going in and buying physical metal, you're taking a medium to long-term view versus CFDs or other assets that are just easier to get in and out of when you want price exposure. But I agree with your point earlier, Nikos, when you shared your view, and I think particularly when you're talking about institutional investors, they will look at correlation data over multiple market cycles rather than what might have just happened in the next, or the last 8 weeks, for example. So I think the fact that, maybe gold's been more correlated to equities in the last, the last couple of months is not a big deal in the sense of the way institutional investors will look at the market. I think the much bigger question that they will be asking themselves, and I think this is very positive for gold, is the question mark about the correlation between bonds and equities, over the next 10 or 15 years, because as a general rule, institutional asset, funds will have much larger bond positions that, for the majority of the last 30 years, have done an amazing job of protecting equity market downside, but going forward are almost certain not to do as good a job. And so, as people look for what is the answer to to that challenge, increasingly they're going to turn to gold. I think it was about 18 months ago, maybe slightly less, that Morgan Stanley came out with their, I wouldn't say recommendation, but their argument around institutional investors, instead of thinking about 60-40 funds, thinking about 60-20-20, where 20 was either just gold or hard assets, with gold as the core part of that 20%. I don't think anything we've seen in the last 12 months, or certainly even the last 12 weeks with the Iran conflict, changes that at all. So, I think the fact that gold and equities have been trading a little bit more in unison recently it's just a short-term market event. It's not a signal that something is fundamentally changing in their relationship.
Thank you. I have a question for Bart, actually, which is a bit bigger picture. Obviously, this is a gold conference or a precious metals conference, but I wanted to get your thoughts on the wider, because your remit is a lot wider than just precious metals, right? So I wanted to get your thoughts on the wider commodity investment landscape. How are your customers looking at the commodity space, whether this is energy, base metals, and how does gold and PGMs fit into that?
Investors broadly, and we're talking large pension funds and large fund managers broadly are looking at commodities at something that's very closely linked to reality, if you will. Example of gold or copper, where the price very much reflects the cost of production. It requires real labor, which over time reflects inflation. If you have high inflation, then you have wages going up. Real capital values, productive capital also is linked to inflation. So the view out there is that as inflation goes up, these factors of production will move up. And they're almost by definition, let's say copper price will embed at 95th percentile the price of its production. And then you have another reality where you have declining ore body qualities. There is less stuff available. So not only are those factors of production more expensive, but you need more of them to create a marginal unit. And if you're in a world where the fixed income market may be, artificially skewed to the downside, where real rates don't reflect duration and risk, then you can say that over the long run, assets like gold will tend to give you an implied yield that's pretty good. So there is a view that these commodities like copper, like gold, like silver in particular, are increasingly scarce. We're going to need them to develop, new industries, electrification, the hydrogen economy, in the case of platinum. And for the long run, they're going to be scarce, more expensive to produce, and they will perform probably better than, let's say, fixed income markets. And therefore, it's an asset class you should hold. Now, that's a school of thought that I think is increasingly out there.
Thank you. Since you mentioned platinum, Bruce, can you give us an update on what's happening in platinum investment demand and appetite in Japan, and where you see things heading? You look for a while, it was lagging gold, and investors were not paying attention to it. But the last 6 months, 9 months, let's say, we saw a bit of a revival. So what's going on now?
Well, platinum has a huge advantage over gold because it is cheap. Well, last year it was like
I think you want to say it's well valued rather than cheap, right?
Yeah, so last year when the gold was in huge demand, it's the same with platinum, especially the smaller bars, like below 100 grams bars are sold out, and big retail players stopped selling gold, platinum, smaller bars like below, I would say, 100 grams bars, because people are queued up to buy those bars. So platinum was very in good demand because of its reasonable prices compared with gold. And nationally, I would say, the Japanese people like white, not glittering gold. So that's the history, and so I think it's coming back better. I mean, investment demand in Japan, and I hope it continues. And I think it's have good chance because it's still like $2,500 discount to gold, which it used to be higher than gold, right? So.
The third question, so what's your view on high and low expectations for gold in 2027?
I'm happy to start. I think this cycle could see gold drop below 4,000, and it would be a sort of heartbreaking moment for a lot of precious metal bulls, but it would be the total cleansing and almost perfect entry point. By the end of next year, I think we'll be back above or close to 5,000. I think it'll take a while though.
Okay. Bruce?
2027? I mean,
Yes, high and low.
High and low.
I think we're more interested in your high, but you can also tell us your low.
I would expect 6,500 high, low 4,000.
I'd have to say, technically the low around 4,000 probably sounds about right. My quarterly forecast high is 5,350, but given volatilities, add another $500 to that as a high. I think that's something reasonable, and then we'll see. The good thing about being strategists and analysts, we can always change our mind.
That's true. Bit easier than putting trades on, right?
Absolutely.
And if we're a bit over, but if I could ask whoever is running the Slido thing to run the poll one more time, I just want to see if we've managed to change people's minds or if the consensus is still where it was earlier. Okay, we can do raise of hands. Who thinks it's going to be over 6,000? Wow. Between 5 and 6? Pretty good. 4 and 5? 3 and 4? Great. Sub 3? Nobody.
A room with no bears.
Well, thank you all for staying with us and tolerating our slight technical difficulties. Thank you guys for joining us today.